Ethan was a young man working as a humble financial planner until one day he found himself in the market for adventure. Coming this spring, his journey will take him to places some never dare to enter. He'll shake things up. He'll break all the rules. He'll risk it all.
Well, actually, good investing doesn't mean you have to risk it all.
Shut up, finance nerd.
Well, actually, I'm
Big Eve, the finance geek.
When it comes to money, you may have heard the saying, no risk, no reward. Generally speaking, this tends to be true. Unless you're my friend Kyle, who has a mom who makes him nachos all day while he plays Apex Legends. He hasn't risked anything except for that saint of a woman. Now, generally speaking, when you invest in the stock market, if something is risky, then you have a greater chance to potentially make more money off of it, if it works in your favor. It's like deciding to play that love song outside of your crush's house. It's really risky, but worth the reward. So if you're watching this, odds are you just started investing or you're looking to invest. Remember when you start dating for the first time? This should be sort of like that. The difference is you'll be getting advice from somebody that has experience. Instead of your Aunt Lisa, who's been remarried 4 times and has been divorced 5. If you want to listen to your Aunt Lisa, that's great. She might say to you, protect your feelings. Settle for the guy who uses 2-in-1 shampoo, who's worked for the same pizza shop for 15 years, and only listens to the Grateful Dead. The investment equivalent would be to put your money in a savings account. Although you gain interest on the money that you put in the account, the interest rate generally doesn't keep up with the rate of inflation. Meaning, in a way, you're kind of sort of losing money over time. But hey, at least it's safer, right? So back to the point. Risk matters when it comes to investment. In the investing world, there's a concept on how to find a good balance of how much risk you should take. That's something called a risk tolerance. Basically, this is the terminology that refers to how much risk you're comfortable taking with your investments, and therefore how much growth you want to see. It should take into account your investment knowledge, your age, your personality, and how many breadsticks you're willing to eat at Olive Garden's Endless Breadstick Night. It will help you decide on that magical balance of how much risk versus reward that's the right balance for you. Investing at its very core is risk management. Think of it like going for it on 4th down in a football game. Possible you can get the first down and move the sticks to get closer to the end zone, but it's also possible to set yourself up for a situation it's hard to come back from. Look at the situation you're in and ask yourself, what can I risk right now? Do I need to risk it all right now? The point is, you want to win the game, so you want to make sure to go for it when it matters. To start off, there are 2 main categories of risk: systematic and unsystematic risk. Systematic risk is a type of risk that you can't diversify or protect yourself from. This is stuff out of your control, like an ice age hitting us, unless if you invested in parkas. The second main type is unsystematic risk. That is the type of risk that you can potentially protect yourself from by using diversification. An example of this is by protecting yourself from one company failing in your investments by owning shares of multiple different types of companies. That way, if one fails, it's not your only option. In investing, this type of risk should be managed and dealt with. Now let's talk about the subcategories of risk underneath the 2 main types of risk that we talked about. Investment risk. This is the risk of investing in something where the investment value may decrease. Pretty straightforward. Timing risk. This is the type of risk that you either invest at the wrong time or you need your money at the wrong time. This is generally one of the more common risks people deal with. Interest rate risk. This is where you invest in something that pays an interest rate and the interest rates change, which could potentially either increase or decrease the value of the bond. Another example is that you get a loan at a high interest rate only for the interest rates to fall after you get the loan. Talk about fading high, am I right? Business risk. This type of risk is the chance of a specific business failing. It's the risk of having all your eggs in one basket. You want to spread those bad boys out, or you may have an omelet instead of a chicken. Currency risk. This type of risk usually applies only to international currency exchange. This is the risk that currency exchanges shift
at a bad time. Think of it like going to buy a croissant in Paris, only to find out that €1 is worth $1,000. Sacre bleu! Sacre bleu! Liquidity risk. This is the type of risk that when you go to sell your investment, it's hard to sell or you can't sell it at all. An example of an investment that's hard to sell is a private company stock. Concentration risk. This is the risk that you have all your money in one investment, and the risk is that one investment goes south like the birds.
Oh, hey there. I know what you're thinking. Is there more? How much risk can there actually be? Well, if you put your mind into a perpetual state of anxiety, there's no limit to the horrors of the human imagination.
Credit default risk. This is the type of risk usually associated with debt-based investments, like bonds. This is the risk that the institution you lent money to cannot pay you back. Reinvestment risk. Reinvestment risk is when your investment makes some money and you go to invest the money in the same investment and you reinvest it at a lower amount and it keeps dropping. It's not a good idea to keep investing if that's the case. Inflation risk. This is where the value of an investment is eaten up because inflation increases faster than the investment. The best example for this is keeping money in your safe. It may be safe, but inflation will eat that value up faster than the cookie monster in a cookie aisle with the munchies. Horizon risk. Horizon risk is where you plan on needing some money at a certain point in time, but then other things happen and you need that money earlier than expected. An example is you are investing money with the anticipation you will need a new car, just for your current car to break down earlier than expected, leaving you without a vehicle to get a better vehicle. International risk. This type of risk is pretty broad, but it's investing international. There are a lot of small risks that come into play here, and it's simply because the investment is international and not your country of origin. Believe it or not, there are still even more types of risk out there, but this covers a good amount of them. Don't be intimidated though, because part of investing and good investment practices are mitigating and minimizing as many of these risks as possible. If you manage risk well, then that will potentially set your investments up for the best chance of success. The truth is, life itself is risky. Just by virtue of doing anything could put you in harm's way. Do you love rollerblading? You can fall and break your leg. Do you like peanut M&Ms? You could choke and die on one of them, especially the green one. The point is, the minute you were born into this world, it was risky. So instead of hiding from risk, acknowledge it, embrace it, mitigate it, manage it, and put yourself in the best position for success. That's our show. Thanks for watching. And remember, investments can be risky, but they can also take you higher. I'll see you next time. That's our show. Thanks for watching. If you enjoyed this video, please consider following. And if you think we can assist you in any of your financial endeavors, please feel free to contact us. Our information is in the description below. Thank you, and we'll see you next time.